this video, we are going to be talking about why Warren Buffett and Michael Burry's latest 13F filings show that they are being prepared for a recession, and what can you possibly do with your money for the best possible outcome. Now, firstly, let's start with Warren Buffett's portfolio. We see that he has sold a bunch of stocks, nearly $8 billion worth of stock. According to his latest 13F filings, we see that Warren Buffett has sold $2.9 billion of Activision Blizzard. That is his top selling position. Whereas his highest buying position in his 13F filings is Occidental Petroleum at $730 million. So clearly we can see that he has sold a lot more than he has bought in the last 13F filings. This selling has led to a 13% increase in the last quarter to a total of $147 billion of cash. Over the past 3 quarters, Warren Buffett has sold $33 billion worth of stocks, fueling a $38 billion increase in cash. Now, why is he selling so many stocks? Why does he have so much cash? This is the classic Warren Buffett theory of basically buying when the market is low. He is saving all of this cash in anticipation of a recession where he can buy these stocks at a bargain. Maybe he will just buy more Apple. Warren Buffett definitely believes to buy low, and especially during a financial crisis or economic downturn. In 2008, during the financial crisis, he struck deals with Goldman Sachs, General Electric, Harley-Davidson, Mars, and other cash-hungry companies. All of this cash that he has gathered in the past 3 quarters is in anticipation for a future recession where he can buy a lot of stocks in a downturn. Now, let's talk about Michael Burry, because he has also done something extremely similar. From his last 13F filings, we see that Michael Burry has bought puts on NASDAQ and the S&P 500 for a total notional value of $1.6 billion. Now, this is an extremely large bet because his overall portfolio is $111 million. Michael Burry has been talking about having a recession in the near future for a while. A lot of people believe that he is a one-hit wonder, but maybe this time it could be different and he could be correct again, like the 2008 crisis. So now let's talk about what should you be doing with your money. We clearly see that Michael Burry, Warren Buffett, literally some of the best investors, believe that there's a recession around the corner, or that's what their portfolios indicate to us. But what should you be doing with your money? That is the more important question. Today I'll be talking about Warren Buffett's bet against hedge fund managers and how he believes that over the course of a long period of time or decades and decades, low-cost index funds are the winners. We are going to be going over numbers and why this is a good place for you to put your money. In 2008, Warren Buffett actually placed a bet for $1 million against hedge funds. So it was Warren Buffett who supported the low-cost index funds like the S&P 500, which basically tracks the top 500 public companies in America, versus hedge funds who have high fees, costs, and expenses. And Warren Buffett believed that over 10 years, low index funds would outperform hand-picked portfolios by hedge fund managers. Now, in the 2017 Berkshire Hathaway shareholder letter, Warren Buffett was 100% sure that there was no way he would lose to his bet. That's how convinced he is that low-cost index funds over the span of 10 years will win. Now, the crazy thing is that's actually not for sure. Because in 2008, when the market tanked, hedge funds were able to show off their strong suit, which was hedging. Buffett's index fund lost 37% of its value compared to the hedge fund's 23.9%. Warren Buffett then beat Protege in every year from 2009 to 2014. But it also took 4 years to pull ahead of the hedge funds in terms of cumulative return. Again, in 2015, Protege was actually ahead at 1.7% versus Buffett at 1.4%. But again, from 2016, Buffett saw a gain of 11.9% and Protege at 0.9%. So you can see the difference here. And another downturn would have actually put Protege to win this bet, but that didn't happen. Because at the end of 2016, Warren Buffett's index fund bet had gained 7.1% per year, or $854,000 in total, compared to the 2.2 per year return for Prodigy's pick, which are 5 different hedge funds, at just $220,000. So you can see there is a crazy difference in the returns you see. Now, the biggest reason why there is this difference is because of the fees, costs, and expenses associated with hedge funds. So hedge funds usually have a 2 and 20 fee structure, which basically means 2% management fee plus 20% for profits. This means that the managers are showered with compensation despite only returning gibberish returns. Now, Warren Buffett actually estimates that these financial literate or elites have wasted $100 billion or more over the past decades by refusing to settle for low-cost index funds. Now, Warren Buffett actually chose the VFIAX, which is the Vanguard's S&P 500 Admiral Fund, which tracks the S&P 500. Now, these expenses and fees and everything really impacts the returns you are getting as an investor. Usually, traditional investors look for a great return on their investment. Ideally, after 10 years, you want a really good return. Whereas for hedge funds, Prodigy say is that their job is to generate positive returns regardless of what environment we are in economically. Like we saw in 2008, Buffett lost like 34%, whereas Prodigy only lost 23%. So investors in general, regardless of whatever economic market there is, they will always have less loss as compared to the average traditional investor, which technically they are correct. That is exactly what happened. Warren Buffett in his latest 2023 shareholder letter says that he has never seen a time where it makes sense to bet against America. He believes that Berkshire Hathaway needed America to do well, but America technically didn't need Berkshire Hathaway to do amazing. The thing with tracking the S&P 500 is there are no costs associated. You are not actively reading or following any super investors or what's happening in the market or what you should do with your portfolio or the different type of financial tools you have, because there's so many financial tools to make money where at a point it is too confusing for the average person who has not either studied finance or is not very financially educated. For those people, you should definitely just be putting your money on a regular basis into the S&P 500, because in the long course of things, the S&P 500 on average has returned 8 to 10%, which is extremely good and beats a lot of returns that these hedge fund managers produce. Now, for context, I want to share the actual return you would have in your investment. For example, if you put $300 per month while earning approximately 10% average annual return, in 20 years you will have $200,000. In 30 years, you will have approximately $600,000. And in 40 years, you will have $1.6 million. Just putting $300 per month can have this big of an impact on your life. You will be not only ready for retirement, but will have so much money that you can do other things that make you happy just by investing into the S&P 500. And whether it's a recession or economic boom, S&P 500 is actually the most reliable place to put your money. So I hope you liked this video and got something out of it. I definitely wanted to share what Warren Buffett and Michael Burry are doing with their portfolio because it is a very strong indicator of what might happen in the future. And personally for me, if I do think that this is a recession or we're heading towards it, I want to buy my favorite stocks, whether it's Apple or Tesla or whatever stock that I've been reading on and following. If that price makes sense to me, I definitely will be buying it. But on a whole, S&P 500 is still one of the best places to put your money. It will grow for you and work for you without you putting in literally no effort. Like, that is how historically strong it is. So I hope you liked this video and got something out of it, and I shall see you in the next one. Bye.